And we're back. The number one greatest podcast. I don't know how to do this. Jason's out sick today. So I brought in the much better looking Chris Haddon.
Well, do we even do opens anymore? Doesn't it kind of just do it for us?
Yeah. So Jason's going to work his magic. Next you know, we'll be live, and he'll cut all this in. So if you're watching this, that means you've already watched the open. But either way, this is the number one real estate podcast we're saying in the country, because if we manifest it, it's going to show up one day. So
perfect.
That's what we're doing. Hopefully this audio works. We apologize. Jason's out sick. He claims he has COVID. I believe it's fake. They all tell me it's real.
Allergies.
I'm going with allergies. But either way, we have a really good guest today. Chris, you want to introduce our guest for the day?
My good friend Jason Hull is in the house today, HMB headquarters.
Thanks, Chris.
Thanks for coming by. We're gonna dive into a lot of stuff. We all do a bunch of different real estate things, lending, owning, side deals, this and that, and we're gonna chop it up.
Yeah, I'm just making sure the audio is good. So, Jay, you want to tell us a little bit about yourself, who you are, and what you do?
All right, just a little bit about myself. Born and raised on the East Coast. Grew up in Annapolis, Maryland. Joined the Navy after high school. Went to the Naval Academy. Kind of went out to California. Lived in San Diego for a long time. Got the real estate bug out there. Read Rich Dad Poor Dad and got super fired up that I could find a way to get some extra income. Bought a couple little deals, little apartment deal, little condo, little single family home, and then I ran out of money. And then I asked my parents for money, and they thought I was crazy, so they would never give me any. So one thing led to another, and when I ended up getting out of the Navy, went and worked for a couple private equity funds, worked for a couple developers, kind of did a couple different things, and once the world fell apart in 2007, started buying distressed debt, which is pretty cool. That was a very interesting experience. And then in 2010, joined Sabal to head up buying distressed debt with them in Oaktree. And then in 2015, we started a lending platform, which was doing home builder lending, bridge lending. And then in about 2016, we started doing Fannie and Freddie lending. We did Freddie first, and then Fannie came a little bit afterwards. But it's been a lot of fun. So today, Sabal is a subsidiary of Regions Bank. So we lend balance sheet, construction to perm, bridge to perm, and we do all the Fannie Freddie things across the board. And still super fired up every single day to do some real estate and hang out with guys like you.
Yeah, no, I mean that was a quick 20 years. That was a
well,
lot
I tried to make it not too complicated.
No, for sure. Backing
to
up
show
a
that
little
I
bit.
actually maybe know something, but I usually forget everything I know anyways.
We'll get into it. It's all good. So you first got into real estate when you were still in the Navy and you were buying some stuff for yourself.
Yep.
Single families, maybe multifamily.
Anything I could possibly find that was single family. I mean, I bought a single family from my mother-in-law who was moving to Florida, and she wanted to sell it for $200, and I talked her into selling it to me for $210, and she gave me $10,000 back. And then I bought a couple little townhouses and condos in San Diego, because when I moved to San Diego, never been there before. I was like, this is the greatest place on earth.
Best weather in the
and then
world,
all my friends from Maryland and then the East Coast came to visit me, and then they stayed. And I was like, well, if I can rent them a room. So basically that's how it all started. And a little rich dad, poor dad too. So that was actually a deciding factor.
And you probably still have them all, don't you?
I still have them all.
You probably still own everyone.
I still own every one of them. It's really funny.
And self-managed.
So I do. I've been self-managing for 20 years. My wife thinks I'm crazy. But
I self-managed one property. It was too much.
I say that for self-managing, you got no gray hair. I'm doing it all wrong. And I mean, I have no clue what's going on. But your stuff. So a buddy of mine, he graduated, just got his wings. He's going to go fly fighter jets, and he's moving out to Norfolk, I think is where he's getting stationed. I don't know, one of the military, wherever they fly,
right?
Wherever they fly the Hornets out of, I don't know. Either way, he's headed
Lemoore, California.
No, then he's
Miramar.
He's going to the East Coast.
Okay,
so he's either West Coast or East
Coast.
Coast. Yeah, he graduated the Naval Academy. But either way, he was asking me, he's like, dude, I'm moving out there. I want to buy a house. Because I think a lot of the guys in the military, they realize really quick that they have a way to make some passive revenue streams besides the military. Is that something that's commonly talked about inside the military?
Well, I think that it was kind of interesting is I started a military internship program over the last year or two, and been taking a lot of military folks that want to get into the real estate business. They've been doing internships with us before they got out, which has been really exciting. But I think, when I first started in the real estate game, you read Rich Dad Poor Dad. That was it.
Right.
I didn't grow up with a family that owned real estate. I grew up,
Same.
So at the end of the day, I had no idea what I was doing. I was kind of making it up.
Right.
And nowadays, I think that for the military guys, every military person I know actually has some kind of fascination with real estate, because they're moving. You can buy a house, rent it, move, buy another house, and the military is making you move. So it's nothing you did. It's a little bit easier to get different places. Plus the podcasts and things nowadays. one of my really great clients down in Texas is an Air Force F-16 pilot that started buying real estate in 2016, and we did his first couple loans. Now he has like 30 loans.
Nice.
So I think the podcast world and the information that's available at people's fingertips have given a lot of military
so
folks
much more.
Right. I mean, I think there's a lot of information that people can get nowadays. But
plus sitting around the barracks, you're bored. You got something. It's like the same thing when I was in the firehouse. I would just sit there, scroll, reading other people's articles, watching videos, looking at properties. Because I mean, it's kind of the same thing. You go in, you do your chores, and after that, the time's free, right? It's yours to do what you please with. So.
And now everybody has way too much money, so everybody's trying to buy a lot of things.
Yeah,
right?
well, the
so
Fed
right now, there's so much liquidity in the marketplace that everybody's trying to buy things, which is pushing up pricing, so it makes it even harder, right?
Yeah. Well, yeah, now's a really hard time to get involved in real estate, especially if you're looking for like deals, like a lot of deals that we probably all saw just 10 years ago. I mean, it's crazy how much stuff's flipped around in such a short period of time.
But the good thing about it though too, which is kind of interesting with real estate, probably the same as like everybody talks about the stock market is, at the end of the day, it's like everybody thinks you got to time real estate. Or time the stock, but it's about time in the market. It's not about time in the market.
Length of time.
It's about just staying in the market. Like the things that I've owned over the last 20 years have been up and down in value 20, 30, 40%. But at the end of the day, it's still great cash flow.
I want to make
Can
sure
you hear me?
I just want to make sure everyone can hear this. So, I mean, this is great content. I heard it on a podcast the other day. I was listening to someone else, and the guy he was interviewing, he said, you know what? Early on, I took a thesis of like cash flow. And then he was buying nursing homes or whatever you call them, skilled facilities.
Assisted living?
Yeah, assisted living. Thank you for the proper term. And then he finally just said, you know what? If I can buy it at the best price I can buy it today, over the period of time, I will make more money tomorrow. And I thought that was a really interesting concept. That
it all depends on what your goals are. But if you have a long-term vision of real estate, not a short-term vision of it, it usually all pretty much can work itself out within some form or fashion. The question is, I was actually having a call on the way here today with a military gentleman that I know, and he was telling me he's going to keep his house and rent it out, but he's going to make $100 a month. And I was like, how much equity do you have in the house? He's like, $70,000. So I was like,
how many hundred? Yeah, how many hundred?
I was like, where could you do with that better with that money? He said, and I said, that's before expenses, right? And he said, pretty much. I said, so after expenses, you got $70,000 locked up in that house. You're pretty much going to run it for free for 10 years. And you lived in it too. So he lived in it before. Mm-hmm. So the question was, well, you lived in it. So you get to basically take that $70,000 and not pay any taxes and go put it in 3 deals or 2 deals or go buy. Yep. So I told him, I said, you need to go buy a 4-plex or a 6-plex or something. Yeah. Like don't make $100 a month and lock up $70,000.
And it was a primary, so you wouldn't even have to go through.
That was my whole point.
Because you have to 1031.
Right, and in 2 years it becomes, then you got to pay capital gains. So it becomes $50,000, right?
All right, we're done. I mean, he gave us 20 years of his life, velocity, capital. That's it. I mean, what's left?
No, but we talk about that subject all the time. Like take the equity into something else or take the cash flow. Like sometimes it's clear, sometimes it's not. Not really a lose.
You got to do a little bit of both.
Yeah, I think that's
like having an iron. Listen, the name of the game for all of us is like you got to be disciplined in what you're doing, but at the same time you got to have a couple. Like you always got to have a couple irons and different fires in our business, but at the same time you have to have just enough so that you're still staying focused.
Yeah.
Right. I mean, look at what you guys have been doing, right? I mean, you still have a couple irons in the fire, but you're still staying focused. Like, right now you want to buy self-storage, right? So you're figuring that out before you guys bought multifamily, but you still probably bought multifamily though, right?
Yeah, we have multifamily in our portfolio. Exactly. We have single family, and now we're starting to wash out stuff that doesn't work for us, keeping what we like, restructuring the portfolio, because I do agree. A lot of people talk about diversification. It doesn't always have to be diversification from like stocks to real estate to private equity. It can literally be diversification inside of real estate because this market's always changing as well, Well, the other thing, too, is kind of interesting is because I deal with so many people across the country is everybody thinks they need to be the GP. Right.
Which is not the case. Mm-mm. Like, you have great friends of yours that are buying deals. Like, okay, you can be the LP of that deal. Just if it makes you you can be a little LP here, you can be a GP there. You don't always have to be the GP. Maybe there's ways to make money that's not necessarily like if you have a great deal and a friend down the street has a great deal in Philadelphia, you don't want to go to Philadelphia buying deals, but he's got a great deal because he lives there. What's wrong with investing in that deal with him? Like, I think a lot of people lose that focus. That's
exactly what we did.
Exactly.
I mean, we got rid of our rentals. Like, we'd rather be LP in a lot of the stuff that we've done with Ian and his team.
But didn't you choose some really bad GPs, though?
Only the best, babe.
Not so far.
Yeah.
Luckily, the assets are good.
Yeah. It had nothing to do with the sponsor. Everything to do with the asset.
There you go.
So.
There you go. You made your money.
You can win either way.
You knew you were making your money when he bought it.
Right. Yeah, exactly. And that's how real estate is, right? You make your money on your buy. But you talk about discipline. How much discipline did you get from being in the military? And I don't know if you want to talk about what you did inside the military, but I mean, how much discipline did you learn there? Because like I tell everyone in the fire department, I learned how to go do the same thing over and over and over again because we had to. We couldn't leave the scene until the fire was out. We had to go do the same goddamn thing every day, and I think that related to us being able to go back every day and buy real estate over and over and over again. How'd the military and discipline help you out in your career?
The interesting thing about it is the military was great, right? It's a great foundation. But I think it taught us, just to be, for me, it was like, okay, you never really kind of give up on it. Like there's always an angle and there's always a way. The other thing though, too, is that I actually think it actually made me a little bit calmer because like I deal with people all the time and I'm like,
be calm
every once in a while. This is calm. This is pretty calm. But what I'm saying is I never really get I don't get too excited. I don't yell at people. I don't spaz out. Like I get calls all the time where people are like, okay, the deal's not closing today. It's going to close tomorrow. And they freak out about everything. It's like, listen, nobody's dying today. Yeah. At the end of the day, like, calm always prevails a little bit, even in real estate. Like how many people all the time do you want to be like, you want to just, waterboard them or something and you're not going to do it because then a month later, they give you actually a good deal. Right. Yep. So that happens. But at the same time, I think the military just provide the discipline of like, I think that a little bit of this business too is it's a third finance, a third operations, and a third you can't teach people, which I think that third you can't teach people is some of the things that I learned in the military. One of the companies I started a couple years ago in 2007, all my regional managers were like property managers, asset managers. And so I hired like a bunch of military folks. And I was like, okay, I don't really know what we're doing here, but we're going to figure it out. And they did a good job of figuring it out. And I think it was some of the discipline they learned in the military, waking up early. I'm not going to say you have to make your bed, but get up early, make the phone calls, be a good person, talk to people, just be responsive.
Organized, structured.
Are you a uniform Nazi? Because if you're not a uniform Nazi, if I don't make it over here, I'm gonna come work for you.
I'm not a uniform Nazi.
All right, I'm in.
No, I noticed that. I noticed that when Andy and those guys started investing with HMB. Because there's a number of them, and there's like, kind of coordinated to a group, and they invest in our loans and deals and such. And I noticed pretty quickly compared to most other folks that they were just organized and on top of it. And if it's like, we're going to get this to you by 8 a.m. tomorrow, I was going to have it by 8 a.m. tomorrow. And in the business world, like you're going to get all kinds of stuff, right? Like if you're talking about certain brokers or like straight salespeople, they might forget about that thing at 8 a.m. tomorrow for 4 weeks. You get all types, but I definitely noticed with those guys that just super reliable, right?
Yeah.
Not hit or miss at all.
Well, and I think some of that comes from like teamwork, and you have other people to be responsible to that they probably teach you over there. Same thing we kind of dealt with in the fire department of just having to go and do it every day, and someone else is counting on you to get something done. And if you don't do your job, it's a difference between life or death, right? Like I think that's where a lot of that stuff comes from. So, so we did cover your 20 years. We're in a really interesting time. The Fed's talking about pulling money out of the market. They're raising rates every other day. You look at loans every day. How much you guys lend on in an annual basis? We lend, now that we're part of Regions Bank, I would say that we lend, a couple $1 billion a year with just on the kind of, let's say the original small balance, like average, so small balance, Fannie, Freddie, we're probably $1.5 billion a year, average balance, $2.5 million. So you're probably doing roughly $100 million a month, and that means to do $100 million a month. That's
all multifamily.
That's mostly all multifamily. Okay. That's multifamily, some affordable things like that, and then now that we're part of Regions, and we'll do mobile homes, larger. We'll probably be like $4 billion a year. But the interesting thing is that the world is still going on, right? Like rates have been risen. Some rates have been rising. One of the things that we're seeing a lot is there's sellers are more willing to take some discounts. The biggest thing that is causing issues on any of our deals today is really taxes and insurance. Taxes and insurance have increased across the board everywhere.
We had higher valuations.
Actually, we just had a deal in Louisiana where the insurance was $22,000 more than originally, which equates to. So it's interesting and easy math for everybody. $1 of NOI is equivalent to $20 of loan proceeds, right? Easy math. You pretty much can do that math. So 20,000. That's there's their loan cut, right? So their loan cut is, they were a little bit there, it's $2,000 equates to about, $375, somewhere around there in a loan cut. So
yeah, so everyone caught that for every $1 of NOI. So
that shows you how important NOI is, though, right?
Yeah.
So call it NOI. People are like, it's like if the toilet runs an extra month, right?
Yeah.
If the toilet runs an extra month you didn't know about, and you're in a place that water's really expensive, and you said, okay, it's $1,000 extra, and you had 2 months or 3 months of $1,000 extra. Once you look at that, if you want to refi later, they'll blend that over the course of your year. You lose $500 in NOI. What do you lose? So as operators, all the operators that are listening, I mean, it's like it's magical, and you know this too because you lend all the time. Like how many dollars how NOI makes a huge difference.
Yeah, I
goes right into debt service, and then your loan amount comes down.
Yeah, because I've been looking at a lot of stuff's trading at stupid rates. It's really easy at a 5 cap. You're 20x your bottom line, and that $1, right? Like in the storage world, we look at adding tenant insurance. We look at driving rates just by 5 cents, and how much NOI that little bit of NOI increases in value over a period. Removing an employee, you move a $30,000 employee, that's $600,000 of value like that. And a lot of people don't think about these things. And I think it's hard, because Chris, we deal a lot more in single family real estate too, is I feel like people in the single family world are like, it's okay, it'll work out. The toilet ran, I'll get it next month. Like, I don't think they're as conscious to that NOI line as it is for you.
Well, you know why they're not though? Because in apartments, the landlord pays water bills, and single family homes, the tenant does.
Yep.
So there's a little bit of difference there. I mean, and it's if you look across the board, like across the board, and this is just, I don't know how we got a tangent on water, but water is one of those things where it's really a hard thing. It's one of the only things in all the apartment buildings that you really have a hard time submetering.
Yep.
You have a hard time what?
Submetering,
yeah.
Oh.
So we look
especially in older properties. Newer properties, it's all there.
Yep.
But when you're talking about the stuff that probably a lot of people are buying, B properties, C properties that you're rehabbing, being able to monitor water is actually very interesting.
Yep. Yeah, your 70s to 90s inventory.
Well, you take a $7,000 bill a month and you make it $9,000. You take a $7,000 bill and make it $5,000.
Yep.
Times that by a year's worth of expenses, it adds up pretty quick.
Yeah. So you get.
But anyways, we're talking about lending, like what we're lending on today.
Well, right? And I was going to say, where do you see rates and like all this kind of like?
I think rates. Rates are pretty much. I think the market's pretty much baked in the next rate hike from the Feds. That's. I think rates are not the biggest issue in the marketplace today at all. It's actually no, not at all. I think the biggest problem in the marketplace right now is expenses, right? For rehab expenses, the quality of material. I mean, if you have 2 properties in let's just say Baltimore, right? You have 2 multifamily properties in Baltimore, and somebody else has 10 multifamily property in Baltimore. The guy with 2, the chance of him paying more for his supplies than the guy with 10 is probably there. And the guy with 10 probably is going to get his supplies faster than the guy with 2.
Yeah,
right.
And that's
so the biggest thing that we're seeing is
18 months or something.
Exactly. So the biggest thing that we're seeing is just cost creep for everybody, and I think that's a real issue that everybody's dealing with. So that just makes it a little bit more difficult.
Yeah, I think a lot of people that didn't execute their business plans, that were taking not stupid, but taking IO money or all kinds of crazy stuff. Because there's a lot of crazy. You guys come up with some crazy loan products, but if you didn't,
I don't have any crazy loan products. He does.
Everyone
Ours
does.
is pretty straightforward.
No, they're all pretty
straightforward.
But there is like the last 2 or 3 years like has been like this rise of the debt funds, and what's interesting is the last up until about 2 months ago, like our bridge is off the balance sheet for the bank, and we're we say we're 50 to 75%, but we're really like 55 to 65, and everybody's like, I don't want that. And I'm like, well, this is actually pretty good because it's really inexpensive on the balance sheet. Right. And they're like, well, we're getting 80% from somewhere else. But in the last 2-3 weeks, it's completely changed because now the debt funds are more expensive, and I think people are actually going back to being like, okay, I really only want 65% leverage, where before they're like, okay, I want 80, and I think because people are uncertain where rents are going. But if you still look at, the rents are still continually increasing in some of the right markets, and some of the markets they're not, right?
Well, and it's going to be a function of expenses. Like you talk about expenses going up, the operators are going to ultimately pass it down, but then there's going to come to a point where there's affordability issues and everything 100%. Else. Yep. So it is it's a very interesting time, and I think something else that's been exposed or brought to light for me as an operator is the speed to execution, speed to market. The faster you can execute, think about it. We got
that's it. That's the number one thing. Like some of the best operators that we know, I'm like, how are you guys doing this? So like, it is all about turning and burning as fast as we possibly can to get to the end. And some people are taking their time, but I also think it's economy of scale.
Single family world.
Economy of scale is a big piece of it though too. Yeah. Like, who gets the buying power?
Yeah. And I think that's, with COVID, I know some people are like using that as an excuse and everything else, but there were still ways to execute your CapEx and get it done in a good, timely fashion, because now look at it from November. What were the rates in November? 2%, 3%, 4%, somewhere in there, and now we're creeping up to 5%. I know it's asset specific, but we're creeping upwards of 4 or 5%. It's almost doubled in a 7-month time frame, 8-month time frame.
No, we were in the low 3s, 2s, depending where you were 6 months ago, and now I think we're Fannie and Freddie are pretty much between 4 and 4.50 depending on where you are. Floaters are still obviously a little bit cheaper, but but CMBS, the CMBS market, they have their ups and downs. They're in the 5s right now. And I would say this though too. Like if you look at the lending markets nationwide, your tier one markets, your Miamis, your New Yorks, your San Diego's, Dallas, Chicago, Seattle. The banks are still pretty aggressive. But they're only really aggressive for their best borrowers, right?
Yeah,
they're not aggressive for everybody else. But then in your secondary, tertiary markets, the Fannie Freddie stuff that we do all the time, like small balance, especially like call it sub 10 million. I mean, we're still the best game in town because we're the only product that's really 10 years in those markets, and we're still in the mid fours. Like we're doing deals right now in Louisiana, in between 450 or call it 435 to 475, which on a 10-year deal in Louisiana, that's pretty good.
I would say so.
Yeah, I mean, a lot of what we've seen in the past 8 weeks or so with things starting to change is just that knee-jerk reaction that secondary markets always seem to have because they don't know what it's going to be, right? They don't know where the market's going to go exactly. Interest rates probably up, but they'll have knee-jerk reactions on underwriting guidelines, right? And that's good for bridge lenders like us, right? Deals come our way because of that stuff.
Well, there's a lot of deals that have been falling out last minute. I mean, especially in the last, you and I were talking about this earlier, which is there's a lot of bridge funds and folks that are right at the very end, it's like, oh, we can't do this, and things have changed magically. And so I think really understanding where people's capital is coming from on these deals that they're closing.
If you control, listen,
people, it's all about right now. It's all about it's not about pricing. Mm-hmm. It's really people obviously always want more proceeds, but the proceeds pretty much fall across. In nowadays world, it's all about execution. 100%. Like, are you going to take a 7% loan or 7.5% loan? They're both 12 to 24 months. You think you can execute faster? One, you guarantees you're going to get you the deal, right? Like the stuff you guys do.
For sure.
Then who do you go with?
Yeah, I mean the pricing, and then also the leverage too. Like they end up, if you can execute, they want 500K for example, and we're willing to do 400, and they're like, I don't want to, but sure, let's do it.
Yeah,
because you can close.
Yeah. Well, how many deals are you guys doing a month right now?
15 to 20.
And what are the average size?
So, I mean, it probably shakes out to 300K.
300K. So there's all the single family stuff.
Single family, small amounts commercial. We definitely have some retail, office, multifamily mixed in.
Got it.
Yeah, and I think another key metric out of this is that most people look at debt to get a deal done. You got to look at debt is going to make your deal better, right? Like a lot of people are like, oh, well, if I can lever this up and I can do that, and then I'm getting 8% of my equity or 7% of my equity, then they're happy. Really, you should have a really good deal, and then the debt should explode that deal and make the leverage return exponentially better, right?
You should have accretive debt to the deal. I mean, at the end of the day, I think that right now, some people. I mean, it's interesting too in some of these markets where people are like, hey, it's overheated. Some of my friends and folks that we work with in these different markets are like, especially like California, they're like, man, I've got some of the best deals I've ever bought in California the last couple of years because nobody wanted to be there. And I still think though, even though rates have gone up, rents have gone up, things look pricey, folks who are local operators that know their market, whether it's Denver, Chicago, Miami, I mean, folks who live in that market, breathe that market, Baltimore, whatever it is, I mean, there's always deals to be found, right? Yeah. Everybody knows there's always deals to be found. It's when you're trying to do 27 markets, I think is when it gets really difficult.
Yep. You need to know your asset class. You need to know where you're investing. You need to understand what's going on with the dynamic, people moving in, moving out, right?
So on that note, besides all the lending stuff and, the company level stuff, what are you looking to invest in moving forward?
I think the world of, I think multifamily is still good. I mean, people still need places to live. Yeah. But my personal philosophy on just investing in general is I think you got to find the best people in that space. I mean, everybody sees an investment perspective, right? Everybody's always seen those. And it's like, okay, I'm going to get a 15 IRR. No, I'm going to get a 17 IRR. It's really nobody really knows where they're going to end up. You got to invest with the best people. I love the multifamily space. I'm not a huge retail guy. I love the RV mobile home park space. I think that's great. Okay. Self-storage is a great space. I just don't know it that well. But I personally invest, with stuff that I like. I invest with people that I like and people that I trust. Do I read every single perspective? Probably not. But I think that there's, the good guys that are doing a really good job. There's ways to, that's who you got. It's like you guys, right? You guys have been working, the two of you have been working together for a while, and you trust that he's going to execute it. Besides the fact that all the deals were bought really well. But you got to track the folks that I think can execute in the marketplace, right? Okay. I mean, is that the answer you're looking for?
Yeah, no. I'm just trying to get a picture of the future a little bit as you see it in terms of the LP type stuff, more passive investing, what you're looking at, like the mobile home park.
I would say, I just think that, the world is what do you want? You want cash flow? You want you want cash flow or you want long-term appreciation? I mean, I think that places like San Diego I would still, own a place in San Diego. You buy it at a 3 cap, but if you want it, what's your term? You 5 years, 7 years, 10 years, you're gonna. I mean, it's irreplaceable real estate, right? There's barriers to entry are huge. And if you have the right local operator there, he can do a really good job, even if it's a 3 cap. Or would you take that money and would you rather buy something in a place like, call it Memphis or Chattanooga, where it's a secondary market where, people, they got down to like 4 caps, right? Like 4.5 caps, 1%, if you have a 4 cap deal and you increase it by 1%, you lose 25% of value in your property. So if you're buying secondary market deals and, cap rates got pushed down from 6.5 a couple years ago and they're at 4.5 now, and cap rates kind of, go back, especially with the increase of rates, go back to 5.5, you basically, technically on paper, you lost 25% of the value of your property with 1% of increase in cap rates.
Yeah.
So you chase yield, or you chase appreciation, or you chase just great operators. And I think that probably a lot of people who watch your podcast probably raise money, right, as syndicators.
Yeah. Sure.
And the truth is, like, you just got to do great deals, right, and give people their money back. And never, I mean, your job is to make. I think job as an operator is you're making people money, right? But your job is really never to lose people money.
Of course, and plan for the long term.
Yeah, plan for the long term.
I mean, a few dozen properties since when was that? Probably early 2000s when you started buying, operating yourself, holding on to it. Haven't sold anything.
Nope.
Like that's got to be a big part of the future, right?
It's a big part of the future, yes, for sure.
Like you told me the conversation about you had with your son one time about the Park City place.
Yeah.
You're like, here's what we do with it. We own it. We can use it. We Airbnb it. Other people use it. We make money. We get paid to own the ski property. And he was like, "What?"
Yeah, exactly. He's like, "So you're telling me we own this for free?" I was like, "We don't own it for free, but there's a little bit of work that has to be done, but pretty much it pays for itself." So, exactly. Yeah, it's a great comment.
Speaking of which,
yeah,
I heard your son's doing a little internship over here at HMB.
He's trying. I don't know if he can make the cut though. We'll see.
I think he's going to make the cut.
He made it past day one?
Well, he has made it past day one. We've been doing some role playing and going to do some loan sales type stuff. And I mean, it's just good that the fact that he's 19 or 20.
19.
That he's even interested at 19, right?
He did call me and ask me if I needed a loan.
Yeah, let me see that spreadsheet. We work something out.
Exactly.
I mean, it's 2022. We're not like you wearing dresses or anything. I'm a little nervous here.
So, yeah, no, because I was thinking about myself at that age, right? Finished year 1 of college. Like, did I want to work and make money? Yes. Was I interested in business? No, not yet. I was not.
I think the exposure to the world nowadays is crazy, though, right?
Yeah.
Yeah. I mean, but just the fact that he's, showing interest and he wants to, possibly look into, finance, real estate, stuff like that as a career later on, and starting now and learn. I mean, it's just cool to start at that age.
I mean,
the fact he's interested.
I got to assume is that you were one hell of a role model for him to even take an interest into it, right? Like, did you have these conversations? Because I got 2 young daughters, 7 and 3. And I never know when the right time to start talking about money and what I do and let them be and just go do dance and gymnastics. Like, when did you start having those conversations?
Well, what's really interesting is I have the world nowadays for the younger generation is very different than it was for us. It's like, what kind of guidance do you really give them? I think that the only guidance we can really give the younger generation is work hard and be responsible, be respectful, be an honest person. But they have he has 10 screens in his he has screens all over the place in his, and trading crypto, or they're just all these things that people are doing. And I think that at the end of the day, though, I think they see that people are making money and they're out there, and he's like, the real thing came down to, he's like, okay, I can make phone calls and I can get commissions and I can support doing the things I like. And he's like, okay, that's a great way to do it. I think they're all motivated. The younger generation, at least from what I see, is they're motivated to basically, they like the rewards of our business, which is, you find something, you get something done, you get rewarded, and whether it's commissions or you sell it and you get more. I think the base bonus world for some of the folks, right, is just, I don't think they really want it.
Yeah. It is cool though that we're able
to
teach.
Did I answer your question though?
Yeah, I think so.
Dude,
Plus, we're always talking about real estate too, and he always hangs around my friends. Yeah. And he did meet a friend of mine that's one of our borrowers who has he came to a dinner with me, and the guy has a G5.
Yeah.
And he's the nicest guy ever. And I was like, do you know that guy has a G5? And he owns 15,000 units. He's like, no, he doesn't. I was like, he didn't fly here on his own.
Yeah.
And once he saw that, he's
cool
like, okay.
Exposed to that.
He's like, okay, I think I'm in.
Yeah.
Yeah. No,
all right,
I
Dad,
mean,
so what do you do?
Even little things. I remember having a conversation with my son. He was probably 7 or 8 at the time. And I was explaining to him that money can grow itself, in a certain kind of account. And he's like, what? Yeah. And this is in Spanish. And I'm like, la plata se crece solo. And he's like, ¿cómo? Like
Yeah.
how? Like
Yeah.
why would that? He thought it was like you have this much and then you buy something and then that. And I'm like, yeah, that's like part of the point of what we're doing here. And just like having that conversation and like a light bulb, and he's like 7. I'm like, okay, this is what we need to be doing, right?
Yeah, it's a tough thing to navigate. Obviously, it's top of mind for me. That's why I even brought it up, because it is. We live in a crazy world. You know, it's an insane world, and who knows where we're going or what we're doing.
But isn't it the same way that you got involved in it when you were in the fire? It's like the same way I got involved in it with the Navy, and same as when you were, when you were at the the firehouse. It's like, you want to, expand your mind, do great things, which is, it's good to see that, the younger generation wants that. The hard part is, I think that it's like, there's this huge 10% of the top, 10% of the bottom, like that have it, never will. And then those folks in the middle, I just got to figure it out. So,
yeah. And I think, one thing you brought up, and I think it'll be interesting, where I thought you were going with, is some of that generation is going to want to go kill, which every generation, but I think that generation is going to kill, but also lifestyle. I think lifestyle
is important.
Is going to become exponentially more important as generations go on. So having respect
because of Instagram, you mean?
Yeah,
that's why you buy real estate, so free cash flow, right?
Yeah. I mean, entrepreneurship's cool. It's all over the place. It's on TikTok. Like someone said, the best lead gen right now is on TikTok. I mean, think about everyone cruising that. Yeah. Lifestyle. You talk about jets and cars and boats and whatever else. Like, I think it's going to be a combination of everything.
It's fun stuff, and it's stuff like when we were like in the '90s, for example, when we were in high school or something like that. Like we did. You weren't told that any of that was possible.
No.
Right?
No. Go to college.
Like you were told, like, you go to college, you get a job. And, and there it is. That's what you see. And just the fact that people are exposed to so many more possibilities now. And we are as adults, which is cool. And then you learn it and you go do it. We're pretty good at, like, the doing part. But this next generation is just growing up with, like, the vision of, like, look what it could be like. We could be freaking Logan Paul, right?
Right, exactly.
A YouTuber making $10 million a year.
Yep.
Or more. It's cool stuff. Yeah.
Well, I don't know, man. I feel like we covered a lot.
We covered a lot. It was all over the place, but it was good.
Yeah. What
hopped around a little bit.
You got any other hot tips that you want to leave with anyone before we go here?
I wish I had a hot tip. I mean, I just think that I think right now in the marketplace, I mean, there's a lot of different ways to finance, but let's just go financing, right? So that's what I do every single day. The only hot tip I say with financing is that, make sure that you really explore your options nowadays, right? Because, whether you're going bridge, whether you're going bank, and whether you're going agency, I think that people would be very interested, like really like pay attention to your cost on all these different functions, because I think there's a lot of the needle's moving every single week on rates. It's moving on proceeds. So I would just say, continue, like what you knew from a month before or a week before is not the same as it is this week, right? I think in our business, it's moving on a daily basis. So
it is right now.
Talk to your professionals.
But yeah, where can people find you?
Oh, find me. Okay, so you can find me at jason.hull, Hull, at Sabal, SABAL.com. My cell phone number 619-888-1975. Sometimes I don't know.
On to the San Diego number.
Sometimes, yeah. I mean, nobody ever changes numbers. I'm not gonna. But text me, call me, email me, whatever you need. If you need some help with any deals, you guys, and even if it's just you want to get on our. So we send out for us. I don't know if you guys do at HB, but we send out. Every Tuesday we send out pricing sheets with Fannie, Freddie, and CMBS quotes on it, with CMBS ranges and Fannie and Freddie ranges on pricing. So if you want to get on that, email me. I'll get you on that list. Or you can actually just go to our website at sabal.com and sign up for it. And every Tuesday you'll get rates that are in the marketplace. So that's really helpful too.
I always like getting the email where it says rates are dropping. I'm like, ooh, where'd they go? And it's like, oh man, it was 1/10 of a point, but at least it moved.
Listen, every little thing counts. Yeah. Every little thing counts. I mean, rates have been going up and down a little bit, but it is what it is, and I think that deals are still getting done, so that's all that matters.
Oh yeah. All right. Well, we'll get all your info into the show notes so people can find you. We really appreciate you having come in.
Thanks for taking the time. Sure.
Thanks for inviting me. I really appreciate it.
And if you guys enjoyed this episode, the best thing you can do for us, the best compliment would be to like, share, tell your friends,
review. We'll take a review too.
Yeah, reviews are good.
Comment.
Maybe we'll leave Jason out of the closing because we do a better job of this. So, but either way, that's the only ask we have. We appreciate you guys, and Jay, again, thank you.
Well, thanks for having me. Appreciate it.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.